Welcome to insurance. What are the advantages of having insurance? First of all, if you have insurance, then you transfer the risk from your business to the insurance company. Secondly, the assets of the business are insured against theft or accidents. The third advantage is that the business does not have to use its own money when there's been a loss or accident because the insurance company will pay. All right, compulsory insurance. Compulsory means you must pay this insurance. The examples of compulsory insurance are UIF, Unemployment Insurance Fund, COIDA, compensation for injuries, the road accident fund. So these are examples of compulsory insurance. You must pay them. And they do have benefits. Let's look at the UIF, for example. What would be the benefits of the UIF as a compulsory insurance? UIF will give you unemployment benefits. So if you lose your job, they will pay you. Maternity benefits. If you're a woman and you need to go on maternity leave, they will pay you. COVID-19 relief. We saw during COVID-19 when people couldn't work that UIF paid those people. All right, so those are some of the benefits of having the Unemployment Insurance Fund or UIF. Now, let's look at the four principles of insurance. One is indemnity, surety, utmost good faith, and insurable interest. The first two are similar. Indemnity is just an agreement, a short-term insurance agreement, whereas surety is a long-term insurance agreement. That's basically the difference between the first two, indemnity and surety. Indemnity is a short-term insurance agreement, whereas surety is a long-term insurance agreement. Under both, you will be compensated for a loss. So for both indemnity, you'll be compensated. It's just that the indemnity is for short-term compensation, whereas surety is an agreement for a long-term insurance. So you'll be compensated in the long term. The third principle of insurance is utmost good faith. So you must disclose all information relating to your risk in good faith. That's what utmost good faith means. The insured must disclose all information relating to risk. Insurable interest means that the insured must express the loss in financial terms. So you should be able to put money to your loss. So I've lost items with 20,000, for example. That is insurable interest. The insured must be able to express their loss in financial terms. So they must be able to express their loss in terms of money. All right, insurable. Here are examples of insurable risks, things that you can be insured against. You can be insured for theft, fire, burglar, natural disasters. So you can get insurance for that. But we also have non-insurable risks. You do not get insurance for non-insurable risk. An example of uninsurable risk would be inflation, prices going up. You can't be insured for that. Shoplifting, can't be insured for that. Changes in technology, can't be insured for that. Changes in fashion, cannot be insured for that. Difference between insurance and assurance. Okay, insurance is a short-term coverage for an event that may or may not happen. So, for example, a car insurance is a short-term coverage. You are covered for a short-term period for car accidents that may or may not happen. Remember, insurance could happen or it may or may not happen. Whereas assurance, on the other hand, is assured it will happen. This is the long-term coverage. It's a long-term insurance for an event that will occur. For example, life insurance, the person will eventually die and that life insurance will have to be paid out to the family. Funeral cover is the same. The person will eventually die and that funeral cover will have to be paid to the family. So with insurance, it's short-term coverage and the event may or may not happen. But with assurance, it's a long-term coverage for an event that will definitely occur. So life insurance, for example, for to be paid to a family in case the person dies, funeral cover, retirement annuity, that's the amount that you'll get when you retire. So assurance is assured the event will happen. Insurance may or may not happen. Insurance is short term, whereas assurance is long term. Now, under insurance and over insurance, we're going to look at this in detail. If you are underinsured, that means the value of your asset is less than the market value. If you are insured, you will be paid according to the average clause, and we're going to look at this. All right. So here's an example of underinsurance. This person, the asset is insured for only 20,000, but the value of the asset is 50,000. How much will the insurer pay if the loss is with 15,000? So the calculation here is to take the insured value. So this asset is insured for 20,000. Then we divide it by the market value of the asset. The market value of this asset is 50,000. And then we can multiply it by the value of the loss, which is 15,000. All right, you can work this out at your own time, but when you work this out, you'll find that the value is actually 6,000. So that's how much the insurer will pay. So we've worked it out according to the average clause, where we take the insured value, divide by the market value of the asset, and then we multiply by the loss. So according to under insurance, this is basically, this calculation here is called the average clause. So basically the average clause is when you are paid according to how much you've insured the asset for. So this asset was insured for 20,000 and the market value was 50,000. So we took the insured value divided by the market value and then we multiply this by the loss. This is the average clause formula. So this person will only be paid 6,000 based on how much they have insured their asset. Now, over insurance means you insure your asset for over more than its market value. So this asset is insured for 75,000, but its market value is 60,000, right? And then the person incurs a loss with 40,000. For over insurance, we don't need to use the average clause, right? But the important thing to realize here is that the insurance company is not going to pay you over because you are over insured, right? If there's in cases of over insurance, for example, in this example, there's over insurance because the asset is insured for 75,000, but its market value is only 60,000, so it's overly insured. If the company or the person incurs a loss of 40,000, how much will the insurance company pay? 40,000. They will only pay for the loss. They're not going to pay more than the loss because you are overly insured. So the average clause does not apply here. If you are over insured, the insurance company will only pay the value of the loss. So if the loss is 40,000, that's how much they'll pay. Thank you, grade 12s.